Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about the dollar. Why is it crashing? If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I think that a lot of what is worrying people that cover financial markets as of late is the fact that for the first time, well, at least in this cycle, we have seen a peculiar price action between the dollar and US assets, mainly bonds. Because while it is true that really from March till I'd say Liberation Day, I mean the week of Liberation Day or Liquidation Day if you want to put a smile on it, if the dollar and bonds were really behaving as you'd expect. And what I'm referring to is that as the dollar went down, you actually saw bonds behave as you'd expect, meaning you saw bonds decline from 470 on the 30-year bond, and we went down to about the low was 433 actually. But after that, starting on the week of April 7th, we actually started seeing something that we've actually haven't seen in quite a while. Meaning yields have moved up, and at the same time, the dollar has been moving down. And it has actually seen a 5% decline from the week of April 7th. Now, this is sparking a lot of concerns, because this isn't something you'd like to see, because the idea is if the dollar's going down, yields are rising, meaning bonds are selling off at the same time where even stocks are selling off. We can just briefly go to the futures. I think that we're down a bit, like another percentage point right here. But overall, we have continued to see stock sell off, bond sell off, the dollar go down, which has brought to light a lot of kind of doomsday takes. Given the price action that we've seen, and I just googled dollar crash, and this is one of the first results, and it really has become, in a matter of a few weeks, I would argue that it is actually consensus right now that the dollar is finished, and that the dollar will continue to crash, and that the euro, the yen, the franc, everything except the dollar will thrive. And again, it's the end for the dollar. And the reason why I'm making this video is because I think that it is in our best interest, whether we are investors or day traders, or whether you just like to watch the world burn in front of the TV while you read the headlines, just to fight back against consensus. I mean, I'm not saying that you have to go all Tarzan and go wild on, and just, let's say, go along the dollar. I'm absolutely not arguing for something like that. I'm actually against going long or short just because something went up or down. I mean, that I've made that clear in my previous videos. But whenever something becomes consensus, usually things are a bit more complicated than consensus view would like to paint. It, and not long after, you usually see the reverse happening. Now, again, I'm not saying, and again, I've said it before, I'm not expecting the dollar to just reverse immediately, just reverse course. In an hour's time, we're going to have a huge green candle, and we're testing 2022 highs. Again, I just want to bring to light a potentially, I want to challenge really the consensus view, and this is something that I've I've mentioned in my previous videos. Actually, the first time I brought it up was, in fact, on the day of April 9th, Wednesday, April 9th, which is when we really started to see, when we saw really the sell-off in bonds reach its, the climax, at least until now, that is. Who knows what the future has in store. And I remember that morning because I woke up and I saw this huge candle, wicking up to over 5%. And I remember making the video that morning, hinting at the fact that potentially those were liquidations. Thinking back, and I thought back to my first days in crypto when I used to see, these huge candles on the hourly chart or whatever. And it was just due to the fact that some poor schmuck got liquidated. He went too heavy on the margin, on leverage, and bang, he just got liquidated. That was my gut reaction to it. And so I went back and I actually started looking at times that we saw this kind of evil correlation between the dollar going up and yields going up. And there are a few examples throughout history. I think that the first place to start would be way back during the first case is really the 1990 recession. And the best place to start is in July of 89. From July of 89 till really October, September of 1990, we saw yields move up by, right here, 135 basis points on the 30-year bond. At the same time, going back to 89 and 1990, we started off at around the, I'll call it the 98 mark, right here. And we saw the dollar sell off until, have a 12% sell off. What followed that from really October of 1990 till 91 were lower yields. All right, let's be generous here. We had a 45%, 45%, a 45 basis point decline on the 30-year bond at the same time when the dollar saw a 15%, I'm getting my percentages all screwed up today, 15% rally, all right? Again, emphasis on the first move. You see bonds sell off, and we're focusing on the long end of the curve, the 30-year bond here. Bonds sell off and the dollar sells off. What follows after that, and this wasn't like, a couple of weeks. July of 89 till September of 1990, that's a year, that's 14 months of price action. That's a lot. That's a lot of time. That's a lot of pain, all right, particularly if you're holding dollar assets. But again, eventually, what happens is the reverse. We get to a point where eventually you see the exact opposite, where before you had the dollar selling off and bond yields rising, after you get the exact opposite. Again, you see lower yields and a higher dollar. The second example I can, point out is really the second example is a lot of examples because it's really 2008. And I've been talking about, 2008, and I've been drawing the parallel to 2008. And I'll be talking about, hopefully I make another video today about TLT and, the parallels between 06 and 08. But there are other examples of, this exact price action that we're seeing today, meaning dollar lower, yields higher. The first example for what happened in 2008 is from the time period that goes from January of 08 till June of 08. And what is important of this, what happened right here, is that right smack in the middle, right here, is the collapse of Bear Stearns. Right here. So in the lead up to Bear Stearns, we have, so right here, I'm not even going to count, I'm going to be generous here, all right? Just try to poke holes in my own thesis. From here to here, we had the dollar go down about 3%, all right? And I'm being generous here with, the measurements. If you go and look at what happened in 2008, where are you? Right here. From really, this is really marking the Bear Stearns collapse from in March 2008. But from January of 2008 till June of 2008, we saw the exact same thing play out. About a 62%, 62 basis points increase on the 30-year bond. At the same time where we were, in the lead up to the great financial crisis, where we had probably the first shock to the system with the collapse of Bear Stearns. What followed after? From June of 2008 to September of 2008, yields proceeded to go lower. All right, they went lower, let's say between 70 basis points lower. Okay. At the same time, from June, right here, till September, to the same week, the dollar went up. Meaning, just to summarize everything, we went from an environment where the dollar was going down and yields were going up. We switched to an environment where the dollar was going up and yields were going lower. Now, this particular, these two red candles here are quite important. And why would that be? Because these two candles right here mark the collapse of Lehman Brothers. All right. And imagine this. You think, the collapse of Lehman Brothers, you'd expect the dollar to continue to move up because the dollar is a safe haven asset. And with the dollar, you'd expect, especially the long bond, to perform well, meaning you'd see dollar up, potentially, continuation of the trend. Dollar up, yields lower. Or at the very least, if you see the dollar going down, you'd expect bond yields to go lower because you'd expect to see a risk-off trade, meaning, the risk-off asset is the 30-year bond, the long end of the curve. But if you go back and look, from the week starting September 15th till the following week, what actually occurred is more of the same. Meaning, this right here is the week Lehman Brothers collapsed. And these are just for reference, right? These lines here. From September 15th till really the week of September 22nd, we saw a 40 basis point increase on the 30-year bond. At the same time, when we saw the dollar sell off. And keep in mind, this came at a time where there was incredible stress in the financial system. All right, now that is definitely above my pay grade. I mean, I'm just I'm just looking at things, and I was small. I definitely wasn't old enough to watch Bloomberg or anything. I was still watching Courage the Cowardly Dog at that point. But again, if you go back and just look at history and just look at what the great financial crisis caused, it was a time of great stress. All right, you had mortgages, dollar shortage, whatever. I'll leave that to the experts. And again, what followed that, the dollar down, yields up, was a reversion. Meaning from that point on, the dollar rallied. All right, we went from, and again, I'm being generous in the way I'm taking my measurements here. We saw a 13% rally in the dollar up until the month of December. And the 30-year bond, from that point on, right here, we went from 442 till, and again, if you want to count this week here, of December 15th, we went down by 200 basis points. And if you want to just measure until the beginning of December, 134 basis points. Either way, lower yields, higher dollar. And again, why am I focusing so much on history? Well, this could definitely be a beast of its own. But what I want to point out is the fact that it usually never pays to buy in the doomsday scenario. And to make that point, I'm going to use Bitcoin. All right. This is something I've mentioned many times before. During 2022, I remember reading a lot of, doomsday scenarios about Bitcoin because, whenever Bitcoin goes into a bear market, it's like, nobody wants to even get close to Bitcoin. But one of the doomsday scenarios that, what if nobody has access to the internet ever again? Then what are you going to do with your Bitcoin? And to that, I would always answer, well, think about what you're saying for a second. If you no longer have access to the internet, most likely something incredibly awful has happened, in which case you're not going to be thinking about stocks, bonds, Microsoft, or gold or silver. The only thing you want in that scenario is farmable land, source of clean water, and a shotgun to defend everything, all right? And how does this tie back to bonds? If we are in a scenario where the treasury market is going illiquid, nobody's going to buy US bonds, and the US is crumbling, at that point, I would argue we're in the scenario I just talked about, meaning we have bigger fish to fry at that point. And again, if we're really headed to that, well, I mean, I'm really, I shouldn't be making videos on the charts I have in front of me. I should be making videos on how to grow crops, okay? So again, this could definitely be a beast of its own. Time will tell. But if history is any indication, number one, I would not buy into the doomsday scenarios, given the fact that they also have become consensus. I challenge you to find someone that is bullish on the dollar on X. You'll mainly find people, talking about the fact that the dollar is dead. Everybody's running away from the dollar. Again, I'm not calling a bottom on the dollar. Neither am I calling a top necessarily on yields at this point. And in fact, just to give you a sneak preview of what I might talk about on the 06-08 comparison for the 30-year bond, could there be a scenario where we actually sweep the previous high in yields and proceed to actually fulfill the price action that we saw, meaning we actually get to see a higher high after the first time. Again, I'll talk about that in the next video. But coming back to the point of this video here, is this a point, where you'd want to, follow the doomsday postings that, the dollar's finished and nobody wants bonds? And probably not. Would I go long right here? Absolutely not, because that is one of the things I mention a lot in my videos, is that just because the price went down isn't a good enough of a reason to go long something, whatever it is. Just because the price went down 40%, doesn't mean it can't go another 40% down. All right. However, if history is an indication, and if we really are in a scenario that is akin to, say, 2008, where we actually saw the price action that we have been seeing these last few weeks, meaning dollar lower, yields higher, what can we think about the future? Well, if we look back, actually the exact opposite. It takes a lot of time. It might not happen today, it might not happen tomorrow, or next week, or next month. But again, if history is an indication, sooner or later, we're going to get dollar going up and yields coming back down, probably in a dramatic fashion. And again, I definitely could be wrong. This could definitely be the end of the world. It could definitely be, a beast of its own that we've never seen before. But so far, we actually have seen it before. We've seen it in 1990, in the lead up to the global, widespread recession in 1990, and we've actually seen it in 2008. And I'll leave you with this. The only time, considering the last three recessions, so 2008, 2000, 2001, 89 to 91, there is one exception. One recession of these three, which I haven't mentioned, which is the 2000 and 2001 recession, where we haven't seen this kind of correlation play out, right? And if, you've probably noticed, I haven't talked about the 2000 time frame, because I spent, not extensive. I didn't spend weeks, but I spent my fair time trying to look at, trying to find, the kind of price action we've been seeing these last 2 weeks, meaning the dollar going lower and yields going up, or the exact opposite, the dollar going up and yields going down. And again, if you do find any such examples of in the 2000 recession, do point them out in the comments section. Particular focus on the lower dollar and higher yields. All right. And I spent a lot of time, trying to find this kind of correlation, and then it really kind of hit me that the fact is that the 2000 recession was really one of a kind. Meaning, if you recall, I think I found the Wikipedia. All right, Wikipedia. I found the Wikipedia. I found it on Wikipedia. I'm using Wikipedia. You like it, hate it, just take it with a grain of salt, all right? If you go and look, really, the 2000 recession wasn't really a global recession. It wasn't really widespread, and you didn't really see, the global recession that you saw in, say, 2008. For example, in the European Union, you saw, if I'm not mistaken, I read it before, France and Germany did enter a recession, but it only lasted 6 months. And it wasn't anything dramatic. And even in the US, granted, you did see a recession, but it was mostly tied to the fact that we had a huge, asset bubble in tech stocks. It was more of an asset story, more of an equity, a stock story, rather than an economic story at that point. And again, which didn't lead to the kind of contagion potentially that we saw in, it didn't really involve the rest of the world like it did in potentially 1990 and especially in 2008. I think that is one potential explanation to that. But again, going back to the point of the video and really just to try and summarize, yes, we have seen some, dramatic action take place in the dollar and US assets, mainly bonds. But I do think that it always pays mainly to be a contrarian and never get sucked in the consensus view. And I think that right now consensus is to be bearish on the dollar. And while it might pay in the near future, I would not be surprised at all if at some point, and I don't know when, I'm not calling for a bottom, I'm not calling for people to go long at this point, all right? Definitely not. Usually, remember what Peter Lynch said, it went down 40%. How much lower can it go? The answer is usually another 40%, all right? So resist the urge to max out on leverage and go long the dollar at this point. But what I'm saying is that don't be surprised if in, say, the next weeks, months, we actually get a reversion, right? The dollar screaming higher at the same time where bonds are potentially going lower. And again, this is notwithstanding, any other doomsday scenarios, and I do include, potentially Powell getting kicked out. I think that is, that is part of the doomsday scenario. And then again, all these things could play out, and if they do, well, I'll be here to talk about them. I hope you enjoyed the video, and if you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.